Welcome to Edison TV. I'm Michelle Livings, here to explore the market's expectation of further consolidation within the online gaming industry. We'll look at what's driving it, what it means for investors, and get an insider's view of how it's shaking down. So first, the facts. The increasing size of online gambling businesses is an established global trend. The total combined revenues of the 5 biggest operators now stands at $16.4 billion, which is more than 300% up over just 5 years. Of course, the market they serve has grown very rapidly. Revenues increased by 70% over the very same 5 years. But this only serves to illustrate how much of the major players' growth is, in fact, being driven by M&A. Why the consolidation? It is, of course, the destiny of almost every maturing industry. But the fuel behind this especially rapid acceleration is twofold: regulation and tax. Both are becoming less benign in the more mature regulated markets outside the US. As tax burdens increase, operators are also having to adapt to advertising restrictions, maximum stake rules, and loss limits. The need to diversify and hedge bets in this environment, as well as find scale for higher levels of efficiency, leads them in one direction: the offices of M&A advisors, often to the delight of shareholders. It is no surprise, therefore, that what began as a consolidation trend in the B2C arena has now spilled over into the B2B competitive set, the software and services businesses which provide the code base, cloud infrastructure and other operational essentials on which the B2Cs overlay their brands and marketing spends. Most recently, Kindred Group, the Nasdaq Stockholm large cap listed B2C with 9 brands and 30 million customers, increased its verticalization with the purchase of a pure play B2B, Relax Gaming, a provider of casino, bingo and poker products. In contrast, Aspire Global is a global B2B provider which prides itself on providing the broadest of product platforms that give B2C operators a hard competitive edge. Bought B2Bet and Pariplay, 2 B2Bs, for their leading position in sport and casino games respectively. And while Aspire CEO Tsachi Maimon paid around $15 million for Pariplay in June 2019, a business that now has revenues of almost $25 million, Relax cost Kindred nearly $380 million for its not quite $30 million of revenue in June 2021. So, to get underneath what's happening as these markets consolidate, we've invited Tsachi to discuss how these deals contrast and what it tells us about the ongoing consolidation in the global iGaming space. Hello, Tsachi.
Hi, Michelle.
So, Tsachi, in order to help us find a handhold in all of this, can you explain the logic of Aspire Global's purchase of Pariplay and the price discrepancy with Kindred's purchase of Relax?
Yeah, thank you for the question. We addressed it 2-3 years ago that the vision of Aspire Global is to be one of the biggest gaming suppliers in the world. And in order to do so, we knew that we needed to acquire more products and to control more in the value chain of gaming. So this was the idea of acquiring Pariplay, which have its own game studio, producing their own games, and also being as an aggregator. So this was the reason we are now controlling Pariplay. And you are so right with the question about the pricing that we acquired Pariplay. Less than 2 years ago, with only 13 million euro. And when we see Relax being acquired now with a very high valuation, and we compare the results and the performance of Pariplay and Relax, which is around the same, but Pariplay have more products to sell. So we believe that we succeeded to create very high value from the asset that we acquired less than 2 years ago. So we are very satisfied from the acquisition and also from the outcome of Relax.
Do you think think there's going to be more consolidation in the markets you serve, the regulated B2C gaming brands and operators?
Yes, I think that consolidation and mergers are part of the game. Of course, it's different in different jurisdictions. It's a different timing. We know to say that in Europe, there are already for a few years now, a lot of acquisitions and the consolidations between one B2C operator to another. I believe that also in the US market, once the market will be a little bit more mature, let's say 3-4 years from now, I believe that also consolidation will be there when an operator will want to acquire its competition in order to trigger more growth. And we are reviewing it, and we believe that it will also contribute to the quality of what is being served to the end users.
So then, what impact will that have on the B2B iGaming universe?
I think that it's a very good question, because when we see consolidations, especially when a B2C also can acquire a technology or a B2B company, so we as a B2B supplier, we see it as a trigger for us to be even better in what we are producing. It's taking us to one level and one step further in what we are developing and producing in order to produce a better product and stickiness to the operator. So I believe that those transactions are pushing us forward to provide a better product to our clients.
What is Aspire's strategy to take advantage of the developing market environment?
So we want to continue and do what we did until now in different jurisdictions, to do it also into the US market, and also what we did with Pariplay acquisition and BtoBet as a sport platform when we acquired them. We want to acquire more products in order to control even more in the value chain. Right now, Aspire Global already ahead of other companies by what we own, and we already shared it with our investors that we want to acquire also a bingo platform and maybe also live dealer. So it means that when we are coming to any jurisdiction, we are coming with several products in our portfolio, and we are able to come even stronger and to control more of the wallet share of each operator. And this, we believe, will bring us to be one of the biggest iGaming suppliers in the world.
That's great. Thanks for walking us through it, Tsachi.
Thank you very much, Michelle.
But of course, from an investor standpoint, this is only one perspective. Fortunately, Edison's senior covering analyst, Russell Pointon, has an even broader view across the iGaming landscape and regularly talks to many players within the industry. So I'm pleased to welcome Russell, who joins us here in the studio. Russell, hello and welcome.
Hi, Michelle. Good to be here.
So what do you think is driving consolidation in online gaming?
Well, I think consolidation is happening in online gaming for two key reasons. The first is that there's just very strong growth in the market, and that's coming from a number of sources. The first is the fact that there are just more markets out there, and that there are more markets becoming regulated and opening themselves up, as you've recently seen in the US. We also have increasing internet and mobile penetration, which is making it easier for online gaming companies to access new customers in new markets. It's also making it easier for those customers to access online gaming versus visiting a land-based gaming business. Secondly, the markets are very competitive. So therefore, as companies look to consolidate the markets, they obviously hope to make competition a bit more rational, and also to seek cost savings, cost efficiencies as they consolidate those markets.
So presumably this is mostly good news for investors.
Yes, well, if we take out of the equation the starting valuations of the shares and the prices that may be paid for some of these acquisitions as the market consolidates, a growing consolidating market should be good for investors, especially if you happen to own the shares of one of the companies which is being acquired. For the acquiring companies, they obviously seek to make the market a bit more rational by consolidating it, and also gain from those cost efficiencies, which should make their operations more profitable. Of course, on the downside, you have the potential risk that those companies do overpay for anything they buy in future, which is likely to impact their future returns.
Right. So we've discussed some of the macro drivers already, but what else do you think is fueling consolidation in online gaming?
Well, what's been interesting in the last 12 months is you've seen a number of the land-based gaming operators acquire the online gaming companies. And what they're effectively doing is acquiring their digital and technological know-how as they seek to transition their brands online.
How likely do you think it is that consolidation will continue? And what do you think the endpoint looks like?
Well, I think it's a given that consolidation will continue because these trends we've talked about, they're far too entrenched. So I think what you ultimately will see is larger companies with more brands in more markets.
Okay, well, that's lovely. Thank you, Russell, so much for coming into the studio. And that's it. That's all we have time for today. If you'd like to know more about the industry or Aspire Global, download Edison's latest research. Don't forget to subscribe to updates on the stock as well. Just click on the link at the end and then hit the Follow This Stock button. Thank you for watching.